Mark, I'd like to go to you first. I mean, first of all, there's a lot of conflicting numbers out there. What the U.S. debt level is, it's $13.7 billion, or as one economist at Boston University says, it's almost 13.7 trillion, up to 200 trillion. You're in Europe right now. The Eurozone is in very bad shape. We have, everyone's talking about Ireland this time. Before it was Greece. Spain is on the radar. Portugal's on the radar. There's an enormous amount of debt out there, and everyone's trying to drive it down. Is that possible, and will we ever be able to pay off these debts, these enormous debts?
One of the things you have to consider here is that while it makes sense for any one country or even individual or household or firm to try and clean their balance sheet if they've got too much debt, if we all try and do it at the same time, all you end up doing is essentially contracting the economy for everyone. What's kind of locally irrational choice becomes collectively disastrous if we do it all at once. So while it may make sense, common sense, to try and reduce debt all at once, unfortunately that might not be the macro outcome.
Okay. Roland, I mean, to continue on that theme there, if everybody does it at once, then it's a race to the bottom here. And it looks like the United States is out in front with its $600 billion purchase by the Fed. I mean, it didn't announce it to anybody. It just did it, and a lot of people are not very happy about it. It's exporting America's problems to everybody else, and that goes basically to emerging markets. The U.S. didn't do everybody a favor, maybe itself, though.
Well, I'd like to
go to Roland on that first. Go ahead.
Sorry, Roland. Go ahead.
First of all, you got to remember that this was pre-announced several weeks ago, and it was very well telegraphed into the markets, and the purchases started. But you know, that's a very different problem than the debt problem. Basically, what you're looking at when you're printing a lot more money, and yes, it is indeed making other countries, and especially in the emerging markets, angry because it has the potential of devaluing or diluting the currency. That is one of the solutions, certainly not one that one enjoys, a solution to resolving debt problems. But let's go back to the debt problem, and a point that Mark just made was that if all the economies contract at one time, it would serve to hurt the economy. But, you know, that's one school of thought. I mean, it becomes one, every dollar that the government spends, does that not take a dollar out of the private market? Aren't dollars in the private market much better spent? Resource decisions much better? I have to take a contrary opinion to that. I feel that if these governments worldwide go on an austerity program, you will see the slack picked up with much more efficiency by the private sector.
Okay, Daryl, let's look at austerity. Who pays for austerity? Is it going to be the rich bankers that we bailed out? I mean, it seems like the same people that bailed out the bankers are going to have to suffer through this austerity because Wall Street is swimming in money again.
Taxpayers are always the last man on the hook because other people are spending their money. And so what we've seen here is a crisis of debt that first broke in 2007, 2008, and the governments moved very quickly to bail out the banks. And this was a matter of necessity because governments, like everybody else, live on borrowed money. In fact, governments, their debts are far in excess of all other levels of debt. And so for governments to keep functioning, they move first to save the banks. And what you're seeing here is a situation where everybody is trying to protect themselves. And as Mark pointed out, this is not functional, but it is reality.
Why is all the cash sitting there? And it comes down to uncertainty. Part of the problem, especially in the U.S., and that's the debate that we just saw going on, especially at Election Day 2 weeks ago. The debate is are we going to continue on this path of spending or not? Are we going to continue a regulatory environment that's really harmful or malevolent for businesses? What you're seeing in the U.S., money is not being spent not because of economic projections going out. It's because of precaution. We have a new administration in here in the last 2 years that has made a lot of noise about spending a lot of money. That's what's holding it back. If there is a definitive plan of austerity in the U.S. and in Western Europe, I have no doubt you're going to see corporations with that kind of certainty start investing the money, put people to work, invest in equipment, invest in research and development, new markets. It's the way a thriving economy is supposed to work. Uncertainty is what's holding back the market, not the financial crisis.
So, Roland, if I can just continue with you, I mean, a trickle-down effect, okay? Once corporations, once big money feels certain, it somehow, some way, new jobs will be created, okay? Like that, okay? Cutting taxes. I think under 8 years of George W. Bush, we lost 8 million jobs in the United States, you know, with a tax cut. I mean, I don't understand. I mean, these people are fabulously rich again. They were always rich, really. I mean, they don't have any, they can sit on their money for a very long time. I mean, it doesn't really matter. I mean, watch the rest of the country go through austerity in the U.S., in the Eurozone. I mean, I don't see the incentives there for them to be save the economy.
I'm certainly not.
Because the way the system works now keeps them very happy. I mean, everything works for them.
I'm not going to be an apologist.
Peter, could I make a point here?
Okay, and so let me get this point in. First of all, First of all, we define the wealthy in the United States in terms of tax brackets as those families that make $250,000 or more, which is certainly not a millionaire. Okay, this is the sector of the economy, of the economic structure. This is the one that creates all the jobs. If you want to kill the golden goose, kill the golden goose. We see what happens. You threatened to kill the golden goose over the last 2 years with hostile tax and regulatory policy, and guess what? They're sitting on their eggs. They're not laying new eggs. So
then if I can jump in here, why is it that the country
and talk? I mean, it's nice
why
to be
is
a
it that other
populist and point
countries
your
that
finger
don't
at
have
those bad guys,
Obamacare?
but look at the reality.
Go ahead, Mark and Bucharest. Go ahead.
Why is it that countries that don't have Obamacare as the big uncertainty, that don't have U.S. regulatory changes, maybe sort of 23 of them or 24 of them that have suffered in the financial crisis, have uncertainty if it's really the regulatory and policy changes that in America that everyone's worried about? If you're trying to explain 20 cases and your causes exist in one, it's not usually a very good explanation. The problem is you have a consumption-driven economy and most of your consumers are underwater. It's a very old-fashioned term, but it's called demand. It was driven by debt right across the public sector and the private sector. And your private sector is too leveraged and underwater. So you can invest all the money you want. No one's buying.
Okay, Daryl, let's go to you in Tucson. Let's go to Daryl. Daryl, go ahead. Jump in. Daryl, go ahead. Jump in, and then we'll go back to Roland. Go ahead.
Yeah, Peter. Thank you, Peter. I want to make the point here because this austerity issue and spending is a prime importance. But what I want to make the point is it's driven by crises. The reason why you have a move to austerity in Europe is because in the spring of this year, the sovereign debt crisis first started in Greece, spread, and all of a sudden the spreads on CDS, on credit default swaps, started skyrocketing, and Europe found out very quickly that they could no longer borrow at the risk because now the markets were afraid that they weren't going to get paid back. The banks in Europe are in systemic pressure, and we were about to blow a valve. All right, so that's why all of a sudden, out of the blue, after 4 decades of excessive spending, you had a sort of a reawakening of austerity or of cutting spending. So that's by pressure, and that was by necessity. Now, the other countries which can still spend is in major economies are like the United States and Japan, and they are doing everything they can to try and avoid the deflationary collapse that they themselves set in motion with excessive credit-driven demand. And that's what they're trying to do. I'm not saying it's right. I'm not saying it's wrong. I'm saying there's going to be terrible consequences. The United States is doing what it feels it has to do, and I don't think it's going to save it. Japan has been in this deflationary trap since 1990. They're one cycle ahead of us. The United States is one cycle behind. We have no export economy like they have. We have huge amounts of debt. And the question of austerity is not so much a policy decision, even though they are going to talk about it. It's going to be driven by the markets, as Roland knows, and the markets are very, and we had the supply side shift in tax situations. But what we did create was enormous asset bubbles, and it was all done on borrowed money. And this is where it's so insidious, and because you can't. I think the problem really is we've gone too far down the road to correct it. The issue, what Roland pointed out was if we get the economy going again, it is going to fix itself. And this is where I want to address the issue of Ben Bernanke's latest push. That theory of restarting the economy is easier said than done. They couldn't do it in the 1930s, and they were more sanguine about it in this crisis because of Bernanke's belief that Milton Friedman's little theory that if you could expand the money supply during a deflationary contraction, it would work. So he came out, they put $2 trillion into the pot, they spent, they slashed, and it didn't work. Now everybody is nervous. Everybody is nervous, and the central bankers,
it didn't work.
The people,
and you hit a good point here. And the reason it didn't work is the problem is not monetary. Deflation is not it's measured in monetary, but the problem is fiscal. Tax policy and regulatory policy clearly is what it is. And you're right. Ben Bernanke's pushing on a string. Listen, the Fed does not have the tools to affect demand. Their tools only affect money supply.
All right, Mark,
and this
Mark,
is
I
what
want to
happens.
ask Mark a question. How about just printing a lot of money? That's one way to get rid of debt. And is that what the United States may be contemplating?
And the money.
This is where I'm going to agree. This is where I'm going to agree with Roland. This is where I'm going to agree with Roland. I'm going to agree with everyone.
That's what they're doing, right?
It's absolutely pushing on a piece of string. I don't think it's going to work. I don't think quantitative easing is the way forward. Look, I think we can all agree on the following. Debt is the problem, whether it's the public sector or the private sector. And to me, what I'm concerned with is the asymmetry of the put. For the past 30 years, as was just pointed out, we rode gigantic asset bubbles. We took the profits. We cycled through equities, through real estate, and briefly through commodities. Markets too small to absorb the volumes. And then we have a big leverage crisis. Then we blow $2 trillion in the financial crisis. And this ends up on the public sector balance sheet because these institutions are too big to fail. At the end of the day, we're asking stretched consumers who are already underwater with their own private debt to deal with this quasi-public debt which has been transferred from the financial sector. I think that's unfair, and I think it's unsustainable from an economic point of view. I think we need to pay down the debt, but we need to do it symmetrically. Let those who actually generated it bear some of the costs. Look at David Cameron's proposal, or the budget that he came out with just recently in the United Kingdom. You have a $1 billion bank levy, but you're taking $4 billion
I'm afraid,
out of
I'm sorry, I'm going to
benefit.
have to jump in here. We've run out of time. I have to say I agree with Mark. I think people that cause this problem should pay for it.